Welcome to Getting Early Equity Investment. This is the first part of a four-part boot camp that CleanStart is putting on with the Carlson Center. And speaking of the Carlson Center, many of you probably recognize that familiar face up in the corner, Cameron Law. And I'm going to let him introduce what he's kind of working on and why the Carlson Center is helping us put this on at CleanStart.
Awesome. Well, thank you, Thomas, and thank you, Gary, for partnering with us. We're excited. As Thomas shared, my name is Cameron Law. I serve as the Executive Director of the Carlson Center for Innovation and Entrepreneurship, and we serve as a regional hub and platform for providing approachable and accessible entrepreneurial education, community, and support to enable startup founders of all backgrounds to scale and launch their businesses. And one of the things we help steward is the Sacramento Entrepreneurial Growth Alliance, which the CleanStart is a key partner on, which is really ecosystem builders trying to foster a more vibrant entrepreneurial ecosystem in the region. And one of our initiatives is to support early stage companies in accessing funds and preparing for that financing. And so we're excited to launch this series in partnership with CleanStart and giving you access to some of those foundations. And you're going to hear from some amazing leaders here in our community who invest in startups and help them scale. So thank you, Jim and Ken, for partnering and being here and sharing your wealth of knowledge, and for investing in our community, and looking forward to hearing what you have to say. So thank you, entrepreneurs, for being here and taking the risk to build your businesses as well. So happy to be a resource. I'll throw in the chat some of the links to plug into. One thing I would give a quick shout out, we're running this program called NorCal AngelCon, and our applications are open through June 1st. And a little high level about that is we have $85,000 in equity investment allocated, and then $20,000 in non-dilutive capital. And there's a process of an application, and then basically will be whittled down to 6 finalists that will compete for that $105,000 in capital in total. So if you want to learn more, I'll share some links to that in the chat, but don't hesitate to reach out to me. And thank you, Gary and Thomas, for the partnership. So I'll let you take it away.
All right. Thank you very much, Cameron. I'm Thomas Hall. I'm Executive Director of CleanStart here, and we focus on building the region as a clean tech hub, supporting early stage clean tech companies.
And I'm Gary Simon. I'm the founder of CleanStart and its current chairman. So I've got a background in starting up companies, running them, selling them, also with Fortune 500 companies. So we're going to try to give you here some quick information that will help you, particularly if you want to apply for the money that Cameron just mentioned. And so look in the chat for where the application is. But time is short to get those applications in. So if you want to do that, I'd go ahead and call up the application right away and start working on it. And that will also help you focus questions you might have for us as we go through this series. It will be conducted after tonight on the following 3 Wednesdays, the 15th, the 22nd, and the 29th. So one thing I'd like to find out, originally we envisioned this as a clean tech oriented session, but we opened it up. So Thomas, can you take it off share for a minute so we can get people on screen here? And I just, show of hands or something. Some people don't have their screens on, but there's the raise hand.
Use the thumbs up function.
Thumbs up. Yeah, so you can either raise your hand, what you are. How many people here are from CleanTech? Okay, there's one.
Steve, I know you are.
2.
Okay.
Yeah, Steve.
There you go. Okay.
Okay, how many people from MedTech? One over there. Okay, how many people are into software and writing applications?
See some there, yeah.
Got a couple of thumbs. And then ag tech. Okay, so we got quite a spread. So that helps. All right, let's go back to the sharing the screen and go to the second slide. All right, so next slide. All right, so we're focusing tonight, we called it early equity investment. It may be angel money, it may be friends and family. And actually, as we go through the program, we're going to talk about maybe you want to look at getting grants and contracts as another form of getting the money you need to develop your project. But a lot of this is going to come back to angels and understanding what they're looking for, I think, is a key part of the process. So therefore, that's why we've invited Ken Tallo and Jim Sperlazza from the Sacramento Angels, both very experienced people that have been doing this for the last 25 years, to give us some perspective on that. So we'll do an introduction from each. I'll conduct a little panel discussion, and then we'll go to Q&A. But Jim, why don't you introduce yourself?
Hi, everybody. Jim Sperlazza. As Gary said, I've been doing this for probably 35 years, actually. I'm currently on the board of the Sacramento Angels. I chair the due diligence committee. So when you're looking for angel money, it comes through mostly Ken and I to start with. So my background is building companies, selling companies, similar to Gary, both on a larger scale and a smaller scale. And I also did it before there was actually angels existed. It was basically friends and family. So I'm happy to be here, and hopefully can share some interesting information with all of you.
Thank you. And Ken, introduce yourself as well.
Yeah, hi everyone. Ken Tallo. I am, as Jim is, also on the board of the Sacramento Angels. I've been doing early stage startup investing for over a decade. Did my first startup in my 20s. It failed miserably. Great experience though, in hindsight. I also am a corporate guy coming out of some large corporations, doing everything from engineering to project management to business development. Currently, I am a partner at Winning Streak Ventures. We're an investment firm that invests in early stage tech startups. I'm a consultant and advisor to a number of different companies. And again, I've been an active investor for many years. I have an interest in technology, love technology, but more importantly, like a business that has the wherewithal to make it to that ultimate acquisition or exit, where all angels and all investors are looking for some kind of gain in their investment.
Well, thank you very much. Let me each ask you to react to a couple of questions here. What do you as angel investors want to see in a presentation that piques your interest and want you to move forward to due diligence? Maybe some good experiences, bad experiences, but give people insight into what this process is like. Angels are not like standard VCs, usually kinder and gentler, and more willing to work with companies to help them shape their business plans and their ideas. But reflect on your experience, starting with Jim, on what you've seen, and what advice would you give to somebody who's just at the start end of this as to what they should be doing to prepare?
So, we like someone that's really done their homework, preferably someone that is looking to present in the space that they've existed in, be it an engineer, be it marketing, be it any type of technological background. I don't want to. I'm going to probably stop listening if someone's in a different space and coming to me and trying to raise money on something they have no information about or no experience in. Once you get past that, to me, I want someone that could present, a really thorough, and make me an expert in what you're trying to raise on. But I I also want someone that doesn't rely on the slides. I want someone that can run through a presentation and close their eyes and still be able to do it just as well as if they were looking at the screen. Because that tells me that they prepared. And to me, that's probably the first, maybe the first obstacle that I would look at is, are you prepared?
Well, that's very important. You know, do your homework first before you come in. And you've got to remember, you may be looking at a pitch presentation, which is 7 to 10 slides, but you've got to know what's behind it. And that's the preparation. So Ken, what's your experience been in dealing with people coming before the Angels and trying to get your interest?
Yeah, yeah. I agree with all of Jim's points. It's to be effective in really pitching your company, you really have to keep in mind who you're pitching to. To your point, angels, right? We're kind of early on in the food chain or funding chain, right, for early stage companies. Angels are willing to take more of a risk for a bigger reward, right? And then after angels, there's smaller venture firms and there's the larger venture firms, and then you can even get into the private equity firms. And you would pitch a little bit different, right? Because you're pitching a different story. To Jim's point, tell the story about what it is you're trying to do with your business. What problem are you trying to solve? And it's the ability to articulate that story very simply. I always ask a lot of entrepreneurs, in 30 seconds, tell me what you're doing. And some of them struggle because that's not enough time. And if that's not enough time, you really haven't boiled down exactly what your business is all about. That's all you need is 30 seconds to pique my interest. Also, if you're doing a tech startup, fundamental flaw, and again, as I'm an engineer by education, I love technology. I will go through schematics, I will go through lines of code, I will go through the physics of operation of your technology, but not in 30 seconds. So what is it that you're doing that constitutes a possible business model that will lead to millions, and I mean hundreds of millions or a billion? Because if an angel doesn't hear that, they're probably not that interested in investing, because angels need multiples because of the high risk, high reward. 98% of all companies that we invest in fail. We're looking for the 2%. So tell me something exciting, something plausible, and how you're going to make hundreds of millions of dollars. And if you can do that and get attention of an angel, then you can go to that next round where I'll give you 5 minutes, I'll give you 50 minutes, I'll give you 3 hours if you want to go deep into due diligence. But you really got to strike a chord with angels to get them excited. And it may be that the angel you're talking to doesn't know that industry, and so they'll just pass. And that's nothing against your business or your business model. It's just, you know, I can't tell you the number of entrepreneurs that have come to me in the fashion industry. I know nothing about the fashion industry, even high tech in the fashion industry. I'm sorry, it's just not my area of expertise. But come to me with another business model in an industry that I am familiar with, you might grab my attention. And so you have only a little amount of time to grab someone's attention, and then after that, it's the story that follows and the information that follows. And angels will ask questions, no doubt. If they find interest, they will start going in deeper in areas that they need to know more.
So due diligence. Let's turn to the chairman of the due diligence committee, Jim. And what's that process like? How long does it take? Give us some of your experience, you know, good and bad on that. But that's where the rubber really meets the road, isn't it? When you can really challenge people as to their assumptions and what they're talking about.
I'm just going to jump in and say, if you want Jim to share all his experience about due diligence,
We're going to be here a long time. Yeah.
I'll sign off and you guys can just continue.
He'll be respectful, I'm sure.
Yeah.
Go ahead, Jim. You got 30 seconds.
Yeah, I got 30 seconds. So I have a 5-page due diligence questionnaire, which is the first pass. And So if I'll really quickly in Ken's 30 seconds, what we do, if you get an opportunity to present to us, you're gonna do your 7 to 10 slides, you're gonna do some Q&A. We're gonna query our group of approximately, well, I think we're around 80 members at this point. And we're gonna find out if there's enough interest for me to pursue due diligence. That taking place, this 5-page questionnaire goes first, and that covers anything from your background, your arrest record, your education, your background, the background of your team, what you're doing, why you're doing it, how you're going to do it, how are you going to adopt. I have a med tech background. My career was mostly in medical devices. So as Ken noted, I tend to go in that direction because I believe in investing in what you know. I don't invest in clothing either because I have no clue about fashion. You're going to be pretty much in my living room for, I would say, anywhere from 2 to 5 weeks, from the time you complete that questionnaire to the time I go through it. And we get a team of people that are experienced in the field that we're looking at. If we're looking at med as an example, we have doctors on our group. We have device people like myself. We have engineering people that understand that. We have FDA people that understand 510Ks, pre-market approvals, those kinds of things. So depending on what you're doing is how much depth I'm going to go into in due diligence. And at every step of the way, and I think Ken can attest to this too, not only are we conducting due diligence, we're also trying to advise you. We've gotten you this far. You've gotten to present to the Sacramento Angels. That means something. You've accomplished a certain amount of things already by being able to that. So we're going to work together, and I'm going to be your short-term mentor, if you will, because I'm going to make sure you answer, cross your T's, dot your I's, cover everything that anybody in our group is going to ask about why we should invest in your company. And like I said, that goes from engineering, it goes from talking to strategics that we probably are aware of. We do as deep a dive as we can. And then the other thing that we do is we find out what other angel groups are being presented to. If it's a case of a little larger organization, if there's a smaller VC firm that's involved as well, then we want to go into your data room. Now, we use a process, I don't mean to go back and forth, but we have a selection process that really covers a lot of ground where we can actually put data room information on this site that we use, and I can share my information with our whole group. So we work with the team, we work with the founders to make sure they answer all our questions, that if they don't have answers, I'll give them a little time to find it out. And at the end of the day, it's 4 or 5 of us probably in the group that decide whether or not we should move forward or not. And I don't mean to say it's, we're not drill sergeants here. We're part of your ecosystem in the Sacramento region. We love local companies. We don't restrict ourselves to local only, but we prefer it if we can. We prefer to look at things that we know. And so we're looking to be your first strategic partner is what we're looking to be. And in order for us to be that, we need to know everything about you. I need to know, can you survive 3 years without an income?
Mhm.
If that's what's going to take, can you do that? If you can't do that, then you're probably not going to make it. So I'm going to be very direct. I'm going to tell you how to succeed, and I'm going to tell you why I think you can or cannot at the end of the day. So it's an education for both of us at the end of the day. I learned something about you, and you learn a lot about me, and you learn a lot about how we're going to not only invest in you, but we're going to follow you. we're not an investor that just says, here's your money, call us in 5 years with our checks. We're with you the whole process. So we've noted, we're looking at younger and younger founders. I think every year that I do this, fresh, some not with a whole great deal of background, but smart people that know what they're talking about, that, as I said earlier, have done their homework. And those are the kind of people we're looking to help succeed and, more apt to probably invest in.
So that 5-page due diligence, I think that's on your website, right? Can people get a look?
It is.
Yes. So, very important to look at that. Just get a advance idea of the kinds of information you're going to need to be providing. And it's been my experience. I was with the Angels for a short period of time, but people can come back. There's probably a limit as to how many times you can come back, but you can walk away being rejected, but with a lot of questions to be answered, an idea of how to improve and come back. Is that right?
Absolutely. Yeah.
Absolutely.
We've had companies come back, founders come back. Everyone should keep in mind, we kind of jump from the, how do you approach the angels to potentially going into due diligence. Jim used the word story, and I used it as well, right? Your pitch to any investor is a story, right? And in that story, you need to cover a number of basic elements, and myself and another board member at the Sac Angels, John Sella, he very well compartmentalized what he calls the 5 T's, right? That we kind of look for, right? It's team, TAM, traction, timing, and terms, right? Those 5 T's constitute your pitch deck, right? And that 5-page questionnaire covers those 5 T's, right? Those 5 elements. But the pitch deck is a story, and due diligence is us proving to ourselves that your story is true. So while you may not have all the answers, right? Maybe there's some parts of the story, such as, hey, you plan to grab, 12% of the market share out there. Well, we don't know that for a fact, but it's plausible, and we have to convince ourselves that it is plausible. That's part of diligence, is we're just trying to prove that the story you just told us in the pitch deck, with all the assumptions that are baked in, are plausible. And that's really the purpose of diligence, is to go in and convince ourselves. And maybe there's some unknowns. Maybe that questionnaire, if you filled it out right now, you can't fill it all out because you don't know. Well, then maybe we pass. But 12 months later, you have answers, you have more information. Maybe your technology has evolved, or your business model has evolved into something different. Maybe you were going to do a B2C, business to consumer, or you went B2B, business to business type company. Okay, you change your business model. That changes a whole bunch of assumptions. Hey, this looks a whole lot better. So we'll go into due diligence again and look at it. And if it looks plausible and we believe it ourselves, well, then you'll get an investment. So diligent, and also diligence is in itself a team sport, right? And Jim will be the first to testify that you never have enough team members on this team, but you want to bring in experts, right? If it's a medtech company, you want to bring in medtech people. If it's ag tech, you want to bring in ag tech specialists or people who have history in this industry. And it could be that it's a great idea and maybe a great product, but the company has an absolutely horrible go-to-market strategy. And to Jim's point, right, we just don't want to say, no, we don't want to invest because you have a horrible go-to-market strategy. We want one of our experts to come in and say, hey, have you ever thought about this type of a market strategy? And if you change it, it would be a whole lot more effective, or we believe the business model has the opportunity to make that kind of a return on investment. And again, it's up to the founders if they want to do that. And if they do, they very well might get an investment from angel investors or the Sac Angels. So, we learn a lot, we give and we take, but at the end, the due diligence process is really about convincing ourselves that the story we heard as part of the pitch is plausible. It could be a successful business.
So tell me a little bit about the investment decision process, because you've mentioned there that it's either an investment by the Angels as a group, or it could be individual investors within the group. Take the first case. I know that at this point, the Angels have a mechanism for pooling money and deciding to invest in companies. So how do you make that decision? Is that a majority vote, a super majority, or what does it take to get there in terms of a positive decision out of the Angel Group?
So
Ken,
the first step is obviously during that presentation, as I said earlier, we have enough members interested in pursuing helping with due diligence, and we will initially get what we call a soft circle. If everything is true, per Ken's notes, the story proves itself out. And we can go to our group and say, this story proves out. This is the market size. This is the opportunity. I need your soft circle number. The Sacramento Angels are unique in how we do our investments. And Gary, you kind of touched on it. We use an LLC to make our investments. So we do pool our money, but we do have a minimum interest level of $50,000. So as an example, if everybody was investing, $5,000, I'd need 10 people to say, yes, we're going to invest. Obviously, that's not always the case. Sometimes it's 4 or 5 people with plenty of money. Our range of investment goes anywhere from, let's say, $100,000 to $400,000, depending on the opportunity. So it's wide open. We do have that baseline minimum of $50,000. That's kind of the decision in itself, Gary, is if we reach that becomes a positive. If we don't reach that, as Ken noted, we're going to say, we have a great deal of interest in what you're doing. We're not quite there yet, or you're not quite ready for us yet. You haven't proved out everything yet. So we're going to pass for now, but we would love to be on your email list. We would love to get your updates. And at some point in time, when you do meet the criteria, as Ken noted, we welcome them back.
well, one of the big struggles in any investment has been, so for how much money I put in, how much of the company do I get? That's the valuation question.
Mhm.
But there's been a change. A lot of early investment groups have moved to this SAFE model, the simple agreement for future equity. Ken, can you talk a bit about what the SAFE is and how the Angels use that?
Yeah. So, as you said, a SAFE is a investment vehicle that promises future equity in a company. So why does the industry use SAFEs? Well, SAFEs evolved out of the Bay Area. Y Combinator was the company or the group that originated them. And originally, SAFEs were just that. It was a promise. Give me money, and in the future, I will give you equity in my company. Now, as you can imagine, when they originally created the SAFE, it's a single 1-page document, maybe 1.5 pages, very simple. And they're very convenient for the founders to raise money. They're not very convenient for investors because they provide the investor no rights. They don't even provide the investor a value of what they just bought, right? So imagine, going to a car lot and trying to buy a car, but you never really know what the price is, right? But I'm going to give you money, and then you're going to give me the car, and then I'm going to own something of some value, but what did I just buy? And so that was the downfall of the original safes. Now, if you go to the Y Combinator website and you look at safes, you'll see a variety of different kinds. One of the first things that investors will want in a safe is they want to know the valuation, right? So they'll put in a valuation cap. So if I'm going to give you $5,000 for an investment and the company's worth 5 million, I can do the math and figure out what percent I just bought, right? Safes are convenient. Founders and startups like to use them. Most early angel investors don't want to use them, but we've become accustomed to them as long as you put in certain information, such as a valuation, right? The other thing is that like a convertible note, there's no time limit on potentially on when that note's going to convert. A safe is open-ended. So unless there's another round, the safe would never convert because that's how safes are structured. So imagine that I give you money and it's a promise for future equity when they do another round. Well, if that round never shows up, we never get converted. So as a presenter, and when you pitch your company and you say, my investment vehicle is a safe, and my valuation is going to be post money at 5 or 10 million. And with this raise, I never need to raise money again. No one's going to write you out a check because that means we're never going to get converted into equity. So again, what I'd like to hear is we're doing a safe round. It's quick, it's convenient. Here's my valuation of whatever, 5 million, 10 million. And in 6 months, I have to do another round. So safes are really good for maybe a bridge round. But not necessarily for a round where you're not going to do a following round for 12 to 24 months. It's just not appealing to an investor. Investors are, they want to own equity in the company. That's ultimately, you mentioned, Gary, about how much equity. That matters to some, but not all, right? Do I need to own 7% or 10% or 20% of a startup? No, many investors, angel investors, don't look at that percentage as a necessity. What they do want to know is that if I put in, say, $10,000 and this company has a potential to do a 10x return, great. I can do the math. I hopefully will make $100,000 on the exit, right? Yes, there's going to be dilution and other things along the way, but that's the simple math. So safes are good for founders. They're not preferred by investors. Investors would like a priced equity round. With that, we also get preferences, terms that give us certain privileges in subsequent rounds. They can talk about anti-dilution, liquidation preferences, a whole number of things. The problem with that agreement is it can be 20 pages long and sometimes more effort than it's worth in the early stages of doing early rounds of funding. So safes have their place, just like convertible notes have their place, price equity rounds have their place. You just need to know which investment vehicle to use at which stage of your fundraising process.
All right, so for those of you who are listening, we're going to be taking your questions here in a bit. The most convenient thing that will help us is if you type the question into the chat, because often several people have the same question and we can consolidate things. So be doing that in the chat while we continue the conversation here, and can explore this a little bit more, because some of what you set up in the safe has to be honored by the next round or the next 2 rounds of investors to make it work. The promises made in the safe agreement. What's been your experience with the reaction of subsequent investors to the safe documents you put together? Is a lot of pushback and the terms change because, last money in generally writes the rules?
Yes, that's a very fair statement. The last guy in writes the rules, right? I've had a multitude of different experiences. In the ideal scenario, in what I would call a good experience, is a startup will do an early stage friends and family, then they'll go to angels, and then they'll go to VCs, and then larger VCs and private equity and so forth. With each round, the value of the company goes up right? Not down, because if you have a down round, that's when your early investors get squeezed or hurt the most. But assuming everything goes up, the company keeps growing in value, all the investors tend to play nicely. Even the follow-on investors will try to play nicely. But if a company gets in trouble, then if an investor walks in and says, okay, I'll write out a check for $500,000, but all your early investors are going to have to accept my terms and they're going to have to lose their preferences and so forth and so on, that becomes quite contentious, right? So Jim and I know well, as an early investor, we have the possibility of being squeezed or, even sometimes cut out of a deal from the later on investors when there's trouble in maintaining the company's valuation. But if the company keeps growing in value, then it's really the duty of the founders of the company to kind of protect their early investors, right? They need to make sure that those early investors are taken care of. So there's a little bit of a dynamic, but I've had experiences where in my career, in my portfolio, I've had 3 companies go public, IPO, which sounds great. And one of them was great, and the other 2 were horrible. By the time that company got to go public on the market, the early investors were squeezed down and in some cases just obliterated, right? I got a check, I took a picture of it for $642 is all I got out of an IPO. I don't want to tell you how much I put into the company, but by the end, that was it. That was all that was left. So early stage investing can be very rewarding, right? Very rewarding. Again, we're looking for multiples of 10, 15, 20. Some of us have been fortunate enough to go beyond that, that limit. But at the same time, we lose, we go to 0, right? There's a process and a model that we'd like to see the startups follow in their fundraising strategy. And again, something that they need good advisors for, right? They need to talk to advisors or early stage investors to understand their needs, what they're looking for. And then early stage investors, angel investors, need to make sure that company has the momentum to carry them through. I find that the biggest valley of death here for most startups, and Jim can probably chime in as well, sometimes it's not getting the angel investors. It's going from the angels to the VCs, where the VCs want to see revenue, right? Angel investor not necessarily want to see revenue. They want to see a great idea. They want to see a good team. They want to see potential. It's pre-revenue, right? But if you can't raise enough money and build up enough momentum before you get to a Series A and go to a VC, the VCs are going to squeeze everybody, right? They may not invest, and therefore everyone's going to lose.
Well, you mentioned something very important, and one of the reasons why we're going to explore it more fully in another class. Building that momentum, proof of concept, proof points in what your business plan is like and what you laid out as assumptions. Very, very important. And fortunately, in many areas, there are some generous opportunities to get some grants and contracts going forward through SBIRs. I know a lot about what's in the CleanTech area. I'm sure there's something
a lot of non-dilutive
similar.
funding, right?
A lot of non-dilutive funding, and some of it is trying to quell the passions of people that want to get to the VCs so they can get to the IPO faster, not realizing the peril that they're putting themselves into moving like that. So that was a great point, Ken, and I thank you for it. Let me come back to Jim before we open up the floor. What can you say about the success rate of the Angels? Ken has sort of hinted at it. Have you seen some really good exits and people are motivated? And of course, the other half of the program that Cameron is running here is to try to get more wealthy individuals to participate in angel type funding mechanisms. Without revealing great specifics, sort of how's it going with the Angels as an investment group?
It's going well. As Ken points out, we know going in, but 98% of the companies are going to fail. We like angels need to have a portfolio of, let's say, 20 companies to be safe, to have some security, if you will, in terms of the law of averages, so that you're going to have a few that are going to make it through. I've been with the SAC Angels. I did plenty of investing in the Bay Area years ago, more in the medical side and IPOs and what have you. The Angels, we had some front end good success, actually quicker than normal. You're usually looking anywhere from 5 to 10 years for a return on your investment. Ideally, we're closer to the 5 than the 10, but 3 years of COVID, that changed a lot for everybody. It changed for founders. It changed for investors. The value of having come through that horrible time is that I know for a fact Ken is mentoring several companies that made it through that tunnel, if you will. And 3 years in, they're still alive. They're relatively healthy, if you will, and they're looking to start raising funds again. So we've been pushed out time-wise a little longer than probably we would have had COVID not taken place. We would have been shorter if the Fed hadn't raised interest rates and changed the landscape for who wants to invest, frankly, based on what your money can do elsewhere. When you can get when you're looking at getting 7 to 10% return on your money with probably 80% less risk than you would as an angel investor, people start looking in that direction as well. And I think some of the money has over the last 3 years gone into other vehicles. But as a longtime Sacramento Angel, a longtime board member, substantial investor over the years, I'm quite comfortable that we've done pretty well. Have all the exits occurred? No, they haven't. I can't sit here and say they have. Do we have a host of companies that will, and the multiples will be in the range where we would love them to be? Obviously, years ago, the famous saying was, the 10-bagger. Everybody was looking for the 10-bagger, right? I mean, that was kind of the first thing you ever heard of, is if you got a 10x return, you were the biggest winner on earth. So that still holds true. People are looking for that 10, that home run, if you will. But you don't get home runs all the time. If you do your homework, and I won't be redundant, and much of what we just discussed is about doing homework, helping companies to succeed. You're also going to get base hits, and a base hit could be a 2 to 4x return. And I got to tell you, there's nothing wrong with that. That proves out what you've done. It proves that you still made a good investment. Was it that home run? No, but I'll take base hits every day of the week because it just ups our odds that much more. And we still have that winner. We still have those few companies out there that could be our 20 or 30x companies that, as Ken points out, that makes up the difference for those 98% that failed.
All right, thank you. So Thomas, you've been sort of perusing what's been coming in on chat, and I know you're very experienced in this area and probably have some questions as well. So what questions would you add to the discussion?
Well, one question that I kind of initially had is, you're talking about returns, and one thing about, private and angel investors that a lot of people are, interested in is the fact that they tend to be a little bit more patient than larger institutional investors. So I was curious about, when you're looking at a company, what type of time frame do you want to see them get to the next step, to either that equity event or that exit event? Are you guys looking at something where it's like, hey, if you're with us for 10 productive years, that's great? Or are you thinking, 18 months and then we're looking how to cut and run? I mean, that's a wide range there, but what type of time frames do you look at for companies for returns?
Well, so there's two things. Well, there's a lot of things we look at, but in general, overall, we expect a company to spend 7 years out there. Could be 5, could be 10, 7 years, right? If you're going to do angel investing, you need to invest monies that you're not going to need for the next 3 to 5 years, right? So it's a longer term investment. But when we write checks out to a company, part of the diligence that Jim talked about was looking at their financial model, right? And one of the questions we ask, of course, is if you raise, say you're raising $1 million, right? If you're raising $1 million, how much are you burning on a monthly basis? And what are you going to do over the next few months? Because say the $1 million lasts you 18 months, right? So in 18 months, you need to take that money, you need to invest it, and you need to increase the value of the company by some amount so that you can do your next round of fundraising. And if you invest it poorly or waste it or have a misstep, well, then you might have to, do another bridge round or do something to bring in additional monies to get to that next milestone. So when an investor makes or when an investor puts money into a company, an early stage company, they typically are investing in what we call seed rounds, right? And you can have multiple seed rounds. Usually you do friends and family, you get a few $1,000s, $10,000, you go do a proof of concept, right? And you work on your business model, but then you do a seed round. And there's no limitation to how many seed rounds you can do. You can do seed 1, 2, 3, A, B, C, you call them what you want. But we watch that, right? And we want to see incremental growth in the value of the company for the money going in. And as long as the company can continue to invest those monies and show that growth in the value of the company, more investors will keep coming in. And that's the whole name of the game, is to be able to keep attracting investors, keep putting money in the company. And so one of the things we look at is if you're doing a seed round, you're raising $1 million and it's going to give you 18 months of runway. Well, do the math, back up. It's going to take you 6 months. You should plan ahead for raising that next round. So 18 months minus 6, that puts you at the 12-month marker. What are you going to deliver in 12 months that's going to increase the value? Not 18 months, but 12 months. Because if you don't hit that and you don't have the increased valuation in the company, then we're going to get squeezed as investors, right? So we have to work with the with the founders, making sure they understand that. Many do. And we have to, again, part of the diligence, right? Do we believe that they can actually use the money wisely in the next 12 months, grow the value? That gives them, 6 months to go close the next round of funding. And we're all good. We move again. We turn the crank one more time. And so that's kind of the process we're looking at, using the money that I have. Again, no startup has 5 years of runway, right? Every startup has months, sometimes weeks, but hopefully 12 to 18 months of runway after they just closed a round. And that's the clock that's ticking.
So if I were to summarize it, it's deliver on what you promise on a timeline that's acceptable, and patient doesn't mean absent.
Correct.
Now we got a lot of
Hmm.
questions in the chat, so
Yeah, go ahead. Dive in.
yeah, so I want to jump on it. Then first from
Did we lose
Gabriel,
Jim?
she had I'm not sure where Jim went. He disappeared. Hopefully he'll be able to get back on. Because Gabriel had the question around the 3 years where, 3 years without income. Could you
Yeah, I
elaborate on
responded to
that
that.
kind of that metric that Jim
Yeah,
put out
no.
there?
Yeah. So here's the thing. If as a founder, you build a business plan, and in that business plan, you say, I'm not going to pay myself for 3 years, well, then we expect you not to pay yourself for 3 years. It's in the business plan. But if you put in the business plan that you're going to pay yourself, so much this year, so much the following year, and then it's part of the business plan. We're buying into that. Where some founders that I've talked to don't realize is that maybe a startup is not right for them for this current stage of their life. I've had founders come up to me and say, I got a great idea. I want to do my own business. And in the conversation, okay, they might have a family. They might have a mortgage and 3 cars and a home in Tahoe and all this other stuff. And I go, good for you. But what does that mean you need as an annual salary? And they're just like, all I need is about $250,000 a year. And the answer is you should not do a startup because investors don't want to pay founders $250,000 a year. Can you do it for less? How much less, right? And so doing a startup, if you have that kind of a salary income requirement, may not be a good thing. Most startup founders don't have those kind of salaries. So you have to have the right expectations, right, when you do this.
Okay.
Oh, I got a text from Jim. He said he got bounced off.
Oh, no.
And he won't reconnect.
Hmm.
Oh, no.
Okay.
Okay.
I'll tell him to keep trying and we'll continue.
Okay. So so on Mark, on yours, I think that's actually a good thing for you to probably actually reach out to the SAC Angels website to ask them about, hey, am I a good stage to pitch or not? Because you have a lot of good details in your technology there.
Yeah.
And,
What about the
and
general principle? The
I
general
think
principle,
they
the
would probably
first
want to
the
look
first
at it.
sentence, we are working on proofs of concept for our fired ceramic semiconductor materials science applications. Is that too soon? We may have viable proofs in a week or 3 weeks or whatever. We're trying to actually planning to do a pitch at, May 18th or so, or no, end of the month. So is that too early, or do we need to already be in production or somewhere in between?
Well, to be in production means you probably invested hundreds of thousands, if not $1 million or more to get to production.
No, it means that we spent years and years and years, and we're both on Social Security.
Hmm.
But I'm working with a guy who pretty much invented solar thin film.
Okay, so if you're at a stage where you think you've built sufficient value in the company and you've de-risked a number of the business aspects and technology aspects, then sure, pull a pitch deck together, submit it to the SAC Angels, go in front of other investors and pitch your idea.
Yeah.
If there's interest, you can go from there, right?
Yeah, what I'm trying to
You'll get
find out
investment.
from you is the level of de-risking that's necessary. So right now, we made a batch. We realized there was a problem with the mix. We are redoing the mix. We expect and hope that it will turn out that this next proof will show that the solar and the battery technologies both work. But we don't know that yet. And we won't, it may take longer. But if we do know that it works, then we're planning to raise $500,000 and get out of the garage into a lab and get some people. So is that too soon for you, or is that far enough along for you?
For the SAC Angels, it might be too early,
Okay.
but for an individual investor who's willing to take the chance, who knows your segment, you could absolutely find that person, that individual, and get them to write out a check to get you further along in the process.
Is one of them in the SAC Angels?
It's worth engaging the SAC Angels on it. I'm gonna have to cut you off on that because we have a
Okay.
lot of questions from a lot of
Yeah,
people.
let's dive through. Yeah.
But I would reach out to the
Let
SAC
me just make
Angels
one
'cause it's-
comment.
yeah.
If
All right.
if anyone thinks they're ready for the SAC Angels, it's a very easy process. Go to the website, build a profile, submit your pitch deck and other information, and our selection committee will go through and they will review it. And you never know, you might get a call and for some follow-up conversations, and maybe even get a chance to pitch.
Okay. In here we got 3 questions around kind of, I guess, the safe discussion.
Yeah.
And I do want to get back to a question that happened before, because there's 3 on the safe. That's one, how do you kind of have a conversation around safes if investors don't like them? And how do you kind of figure out the terms of a safe with an investor that might not like it, or do you broach that, hey, I want a safe, but I'm open to a convertible note.
Sure, sure. So a safe by definition is a form a document that you pull off of the Y Combinator website. They have different flavors of safe. And it even says at the very top of the agreement that if you touch this document, you have to remove this line that says you got it from the Y Combinator website. So you basically use them as is. You fill in the blank that says, if it's a cat safe, you fill in the blank, what's your valuation cat. So you can go through and just pick the safe you want. And it's very cookie cutter, right? Very simple. There's nothing to negotiate other than the fact that the investor may come in and say, I don't like safes, right? And I'm that guy, right? I'm that guy. I don't like safes, right? So I'll say, first of all, is it cap safe? Yes. When are you raising your next round? Because a safe is kind of a loan. I want it to convert to equity, and there's a tax reason for that I won't go into, but I want to own equity in your company. When are you going to do your next round? And if you say 24 months, 18 months, 2 years, whatever, I'm not interested. But if you say, oh, 6 months, 9 months, a year, I might be interested. Sure, I'll sign the same. But if I'm not happy with it, I will suggest, what other investment vehicle do you have? Next thing you would probably go to would be a convertible note. Now, a convertible note does have some terms in there that we can discuss about the cap, the timeline. You know, convertible notes typically might have a discount or interest, and we can negotiate those several items, right? To get a convertible note, you can find forms and templates online. You can go to your favorite attorney and see if they have a convertible note, and that might be agreeable. We can negotiate that out in probably a week or two, and we move on, right? If the convertible note or the safe isn't acceptable, what I really would like is a priced equity round. Well, that can be a 15, 20-page document. In that priced equity round, if it's preferred shares, which is what I want as an early investor, my preferred shares implies that I have preferences, which are just special terms for your early investors. I can have 3 preferences, I can have 30 preferences, and that's what eats up the time of negotiating that. So then there's this concept of lead investors. So sometimes when you're in pitching and somebody will say, even the Sac Angels, right, will ask, you know, you're doing this round, you're raising $500,000. Do you have a lead investor? And what we're really asking is, has someone already come in, done due diligence, and negotiated the terms of the investment? If it's a safe, you don't need a lead investor. If it's a convertible note, you might need a lead investor. If it's a preferred equity round, you need a lead investor. Someone who probably wrote a big check, took the time and the effort to negotiate out all those preferences. And so now I have a 20-page document with some preferences in it. And if we're not the lead, we're the followers, we accept that, right? We have to accept that. And we sign the same document as every other investor in that round. So that's the concept of a lead investor. And then preferred equity stock purchase agreements are the best way for an investor to make an investment in an early stage company, because we get preferences, right? Hopefully that makes sense.
I
right,
can definitely make some follow-ups on that.
Well, let me ask.
By the way, we're touching on a number of topics. We have training classes for our investors in the Sac Angels. We can spend 2 hours talking about just contracts, safes,
Right.
convertible notes, you know, priced equity rounds. We can spend 2 hours talking about that. We're just touching on a number of different highlights here. You know, we
Riveting 2 hours, I bet, too.
had classes to talk about, you know, how to, you know, how to do diligence and how to do selections. And,
Sure.
you know, we can spend hours talking about that. But let's roll through the questions and try to get as much information out there as we can.
All right. Well, I promise you to you know, take no more than an hour of your time here, but let me just jump in here, Thomas. Here's a good question. As far as a minimum viable product, if one's got a non-working prototype and you need the money to make it working, basically, is that an investment for an angel fund? Does it make a difference if the tech algorithm behind the MVP is patented? What do you want to see in terms of proof of concept?
Yeah. So somebody brought up patent. Okay, so intellectual property. Um, an angel investor wants to feel like they have, or the company that they're investing in has some kind of technology advantage, right? I personally like investing in tech startups. Why? Technology is an advantage. What is the technology? Did you invent it yourself? Do you have a patent on it? How do you keep competition out of your space, right? Out of copying your product. That's where patents and trade secrets and all this other stuff comes into play. Again, another hour-long discussion about intellectual property and how to protect it. But as an investor, I want to hear, yeah, you have intellectual property. You are protecting it. It could be a secret, or it could be something you patented. Now, we all know that now everyone should know that it probably takes about 3 years to get a patent through the patent office. So the fact that you applied for it doesn't mean it's been granted, but it makes me feel good as an investor that you're trying to patent this technology. I might even want to look at your patent application and look at what you're claiming. And maybe it's already been, gone through a couple iterations with the patent office, which makes me feel good because they haven't completely rejected it. It still has, legs and can continue on. But you want to know that this technology or this company's special. They're doing something unique, right? And do they have to have it all working? No. Is it better if they de-risk some of the technology? Absolutely, right? So you'll find angel investors at all stages. There's some companies that I've invested in that I want to know that the technology is working, and I don't see any major hurdles going forward. It's a matter of just building it out, right? They're not breaking any laws of physics, and all the other elements are already out there in the industry that they either can build themselves, license in, or what have you, right? But then I've also gone out on that limb and invested in companies that had a really interesting technology that they needed to develop. But the amount of due diligence required to get to that place where I believe that there was the right team, the right technology, and the right market to go disrupt, sure, I'll take the risk, right? And you can find those kind of investors, but they really have to be knowledgeable of the market and the industry, the technology that you're trying to bring to the market.
All right, one more question, Thomas, and we'll need to move on.
All right. Well, one question we had is, in the of money that's going out there through VCs and different sources, there's been, a recent more influence on, women and the BIPOC community of making sure that there's that they're getting, that they're able to pitch and they're able to go after some of this money too. What is there anything that, the angels have focused on, or any angels in the area that are, thinking about this more closely, I guess?
More around diversity and investing.
Yeah, diversity investing, ESG.
What you will find in the Sacramento Angels portfolio is a very diverse group of founders, right? Underrepresented minorities and, female founders, and just you name it, it's there. Do we go out of our way? Maybe, but I think the reality of it is really, if it's a good idea and it's a good founder and they have a good business strategy, we'll entertain an investment. And are we going to invest in something that doesn't sound good or doesn't have the possibility of, that 10x in the future type of return? The answer is going to be no. But we're very pleased with the diversity of our portfolio. We talk about that at our annual kind of our year summary. We talk about how much we invested over the past year, how many different companies, those that got to certain levels of valuation and status. But yeah, we have a very diverse portfolio. It's not like we're trying to hit any metrics, but we do. We have a very diverse portfolio.
I would note, I think you guys have a really good relationship with Fourth Wave, correct?
Yes, we do.
Yeah.
Yeah.
And I put a link in there to the SAC Angels, their community page, which does list CleanStart. We're not an incubator though, but we're there along with Fourth
Wouldn't get
Wave
changed.
and other groups that are there, to engage with in the community, and that Sac Angels works to, represent investing into Sac.
Yeah.
All right. And so, Gary, you want to?
All right. Ken, thank you very much. I'm sorry Jim couldn't make it back in, but we'll tell him how much we appreciated his participating in this as well. Round of applause for this presentation. I mean, this has just been tremendous amount of information compressed into a short amount of time. And as you said, Ken, you're just skimming the tops here. And in fact, this short course that we're putting on is intended to be, skimming over the top so you can get the information fast. So we very much appreciate that. What we're going to do now, given that we've been at it for an hour, is we're going to take a break until 7:10. So that's like 3.5 minutes. But we all need an opportunity to take a break here. We'll come back at 7:10. What are we going to talk about? We're going to talk about what are the important things you need to focus on to do that homework that Jim and Ken were talking about. How do you go about it? There is an organized way to accomplish that. And we'll walk you through that very quickly, and you can study it more on your own. So back at 7:10. Take a quick break now. And again, Ken, thanks very much for joining us. You can come back if you wish, but you've been most helpful, most insightful in what you've given us.
Thank you,
Great
Ken.
questions, everyone. Thanks.
All right, it's 7:10 here. Hope a lot of people have been able to make it back. What we're going to do now is we're going to play a short video that sort of introduces a systematic way of getting your homework done in advance of going in front of somebody like the Sacramento Angels. We've heard that their due diligence 5-pager is online. You could read it, realize what you have to do there, but there are a couple very important things that you will need to nail down as you make a presentation in front of an investment group like that. So our future presents many challenges that threaten global sustainability. Meeting these challenges will take out-of-the-box thinking and new ideas. Do you have an innovative clean tech idea that you're ready to bring to the marketplace? Well, the world needs you and your vision. CleanStart and the other members of the Blue Tech Valley Consortium are here to help you get started. I'm Gary Simon, founder and chairman of CleanStart. We founded CleanStart to help those with great ideas see them succeed in the marketplace without making so many mistakes. In this video, CleanStart and its experts summarize and share the steps to becoming a clean tech entrepreneur.
Being an innovator requires persistence and dedication. It's not easy, but it's necessary to secure our future with innovative solutions to emerging threats to sustainability. You can innovate with an existing business, or you can be an entrepreneur and start your own business. Regardless of which path you choose, the questions you need to answer are the same. The important point is that you can do it. Many others have and are now reaping the rewards, but your chances of success are much better if you follow some easy steps.
Most people start by worrying about where to fund the development of their idea and building a prototype right away. That's not the best place to start. Investment capital is plentiful for good, innovative ideas, but establishing whether or not your idea is valued is important before seeking investment. If you can make a compelling case for your vision and can justify your projections, acquiring funding will be much easier.
Contrary to popular advice, a business plan is actually not the ideal starting point for innovators. Before developing a business plan, you need facts on which to found your business. Begin by creating a 9-part business model canvas. It is all about collecting evidence and validating or changing your guesses about your product and its place in the market. The first part of this process is identifying your potential customers and finding out if you would supply a product or service that they would truly value.
It is really easy to make legal mistakes in creating a business, But the good news is that many nearby law firms will be glad to explain those basics for free. So take advantage of that help early on.
Roughly 70% of tech startups fail because they're making a product or offering a service that is not in demand. This large percentage of failures demonstrates the potential for startups to waste time, monetary, and emotional capital. But why do so many fail? Because they didn't research if there was demand for the product they sought to supply. Instead, many startups devote their resources to creating a prototype or building a team or designing a website, just assuming people would clamor for their product. Then, if demand did not meet company expectations, panic would ensue among leadership, rank and file employees, and investors. Shortly thereafter, another startup fails. It makes much more sense to start by trying to find out if you would have customers clamoring to buy your product beforehand, and adjusting your vision to the desires of your potential customers upon doing that initial research. This ready, aim, fire approach sounds so obvious and simple. Why would anyone do it backwards? The most obvious things customers value are saving money and saving time. But think more broadly. Can you eliminate hassle? Can you allow customers to do something they simply could not do before? Interpret what a customer says they value, and then convert that into offering them something they never knew they needed. Customers wanted faster horses, and Henry Ford gave them the Model T.
In a customer discovery process, you might find that the party most interested in your innovation is not the final user. It is a manufacturer that sees your innovation as a way to improve an existing product that they already have. It is a vendor that sees your product as something that they can also sell to their existing customers. Your customers may not be numbered in the millions. Actually, they may just be a handful of established sellers of other products, and that could be a good thing.
Learning about who your customers really are and what they value is a huge positive step in increasing your chances of success as an innovator. It's a big step just switching from the typical ready, fire, aim to the better ready, aim, fire approach. These are just two of the questions in the Lean business model canvas, but they need to be answered before moving on to the others. The other questions include, how are you going to reach your customer? Over the internet, door to door, through distributors? What are the competing products and services, and how do they compare with yours? What are your unfair advantages that you will overcome your competition? Patents, loyal customers, great customer service? What are key forward-looking measures that show you are succeeding? Rate of growth in new customers, increased sales productivity? What resources do you need? A shop, an office, an accountant, a contract with a manufacturer, a cash flow loan? What are the costs of making, selling, and delivering your products? Be sure to include that administrative cost. What will be your forecast of revenues? What evidence do you have for the rate of growth in sales? Looking at all of these, will you be profitable? Will your revenues exceed your costs? If so, you have a commercial idea. What's next are an indication of how buyers might value your business once it is profitable. If you're an innovator seeking to make an impact on the world by bringing your product to market, CleanStart and Blue Tech Valley can help. We can serve as a gateway to the resources and training you need to boost your startup to success faster. We offer classes, workshops, and advice. We can point you in the right direction. Networking puts you in the loop about new opportunities, resources you could use, funding sources, deadlines, and leads on customers. You also need to find out what learning resources are available so you know where to look for advice and inspiration. You can go to our website to get a list of resources. You can also use the website to sign up to be notified of all future events. And if you want to learn more, make sure you subscribe to our channel.
All right, so some of you are very familiar with what was presented there. But the basic thing that we're trying to get to is there is an established and efficient way to go through and do your homework. It's this thing called the Business Model Canvas. It has 9 areas of interest, questions that you want to look into and make sure you've got good, solid answers in each of them. It is not something you're going to be able to fill out between now and when the applications are due June 1st. It takes time, and it's also an ongoing process. You can fill it out once, then come back to it and realize, well, that wasn't exactly the way to do it. But what's the biggest mistake startups make in creating a business? Well, Melanie in that um, video we just watched said it, is that you didn't start with asking whether anybody wanted to write a check for what you have in mind. Who is that person? What is their pain point? That's probably one of the most important things to understand. When you talk to an investor, they want to know that there's somebody out there eager to get your product. How are you going to find that out? You've got to talk to a lot of people, and I'm talking hundreds, and zero in on what is the real thing that is a pain point that you can relieve with your product. If you can't figure that out, you're not going to get an investment, because it has to be compelling enough to get people to spend money. And when you can make that clear to a group of early stage investors, that gets you through a lot of the due diligence right there. But then it goes on. What exactly is the product you're proposing, and how does it relieve the pain that you've just identified with customers? What do you improve? Is it just savings? Is it something else, reducing hassle? Is it something that unlocks other time that they're wasting right now? One of the people that were on here, don't know whether Steve is still on there or not, has a wonderful product for identifying microplastics in water. There are some rules now that require testing of the water, but the standard way of doing that testing, you get about 2 samples done in an hour. He's come forward with a product that can do thousands of samples in an hour at a much lower cost. That's a compelling story. So if you can make a big change like that, if you can really identify that you can alleviate pain, that's a lot what it takes to convince an early stage investor. Now, they also want to see that you got the rest of your ducks lined up. You know how you're going to do it. You have the team. You have worked through some of the difficulties of how you manufacture this. Those are all in the 9 questions that we've talked about. If you want to find out more about that, just Google on the business model canvas. And there are plenty of people that will give you advice on it. And there are plenty of books you can read about it. But it all gets down to this proposition. Spend your time doing your homework when it's cheap to get to these answers. The worst time to discover what your customers really want is when you spent $1 million to put a product in front of them, only to have them say, well, it's interesting, but I think we're doing okay with what we have. So that's the biggest thing we want to get across here. Now, what's the number one job for you as a founder or as a leader of a company to do? You've got an idea. You've got a vision. You have some notions of what people want. You want to convert all those assumptions as much as you can into facts. You need to build your company based on facts, not assumptions. How do you get the facts? You have to keep throwing ideas, maybe some test product out there to get an idea of how people are reacting to it and whether it's generating any interest. And you need to figure out who your customer is. It may not be all 300 million people in the United States. It may be 5 companies that are producing a product that can incorporate yours and make it a better product. They may be your customers. a lot easier to deal with a few wholesale customers than millions of retail customers. But you need to think through what that is. So as Ken and Jim said, make a plausible case. If you say you want to reach 10 million customers, you've got a mass market product. Okay. Is it a physical product? Are you going to have to deal with returns and dissatisfied customers? Are you facing the prospect of building products wrong and having recalls? How are you going to do it? You have to think that through carefully. If you have a software product, you could get millions of copies out there very quickly. But what if you start making version 2, version 2.2, version 3, version control? How are you going to deal with that? How are you going to deal with unsatisfied customers? What amount of effort are you going to put into the customer experience and making sure your customers are satisfied? You can't run a company by just dealing with selling the next new customer your product. What do you do about the whole inventory of customers you already have? One bad experience in that customer base can ruin your reputation in the marketplace. So be careful about how you set up the whole experience for your customers out there.
And
So
Gary,
go ahead.
I wanted to kind of tie this also back to what, the SAC Angels were saying, is there's two things that I kind of heard them say over and over again on what they looked at. One was you and your team. Like, they want to know that down. And then the other one they talked about is, this multiple return that that can promise them of 10, 15, 20. I think Jim said he wanted to see companies that could be worth 100 million to $1 billion. And, you to have a company that's worth that amount, you have to have hundreds millions of sales, billions of sales. And if you don't have a grasp of, how you're going to sell that or how they're going to buy it, having a cool technology or saying, hey, I've got a better technology is not going to do it. There's always a better technology out there, but it's not always the one that everybody is buying all the time. So when you're going, so when Gary's talking about really understanding your customer, their pains, their gains, and how you can alleviate them by doing jobs that, you see in the value proposition and the business model canvas, that multiple, that ability to sell and get it to the customer, that it was the one thing that I heard them say over and over and over again. Convince me that you're going to get a multiple. And you're not going to convince them that you're going to get a multiple unless you convince them that you can sell to this technology to those people. Sorry.
So Cameron, I mean, you put on classes on this all the time. What would be your comments on the question of how do you go about doing that homework?
He might not be
Cameron's
near his
still there.
computer, he told me so.
Okay.
Yeah.
Well, Cameron and the Carlson Center, they do a number of classes on the business canvas model. It is the approach that sort of set fire to the whole startup landscape, so that when you face an investor, it's highly likely you'll get a question that says, well, I'd like to see your business model canvas. I'd like to see what you filled out. So if you're really serious about this, you need to join some classes and figure out what each of those 9 boxes are, how you go about it, and how it fits together. It's not something you're going to learn overnight. And it's just something that you're going to have to build up over time. But it's important to start it with customer discovery and what their pain points are. Let me pause and see if there are any good questions coming up here that you want to talk about. Oh, by the way, Leslie, on the question that you asked about not having a working product, it's okay at the early stage. And, we'll talk about it in the May 22nd and the May 15th class. You probably don't get the money to get that working prototype done from an investor, but there are some very efficient ways now to find a grant opportunity that would let you do it. And there's more available than people understand, probably 10, 20 times more in grant money available and sources that you ever knew about. So we'll talk about ways of how you open the doors to that grant money. But I wouldn't expect even the angels to pay you to create something to prove your concept, but you can get it other places. You can get that money many other places. So please come back for those days and we can talk more about that. But you had a very good question. Okay, other things that are out there, Thomas? Or anybody else?
Jose had a question on startup operating as a nonprofit. And is Jose still here? Is he on here? Well, I guess he's not here, but what I was going to say is, a nonprofit is a tax implication. It's not a business plan. So if there's a reason that you want to be a nonprofit because maybe you want to engage with the community or do something more, remember a nonprofit is a tax designation, not a business model. You might have a business model that might benefit from being a nonprofit, but it's not. Don't really conflate the two. You can be a for-profit company and go help the community too. Yeah.
Yeah. So, I mean, if you would like to become a nonprofit, you're going to be more in the world of applying for grants for a long time. But what you will find is many of the things that granting agencies want to see in applications are the very same questions we've just been talking about. You may not get an equity investor interested in investing because, they want a return. You can do it other ways. But I think the key insight is whether it's a granting agency or an equity investor, the questions are going to be very similar. For the population you're targeting, why do you think they need the service or product that you have as a nonprofit? And what's your evidence of that? Okay, there was another hand that was raised here. It came on and went off. Okay. Other questions?
Hi, Medina. I would encourage you checking out Fourth Wave. They've been supportive of female entrepreneurs, and they do have experience with tech based startups too. And they actually have an upcoming program on it. I'll send that to you also. So do we have any other questions around this initial class? I see this something in there.
Angel funds won't do a nonprofit, but will do a public benefit corporation. Yeah, that's basically what Thomas was saying. So you can still have the profit motive in there, and equity investors will be interested. It's just the structure that you pick.
Mm-hmm.
Okay, one of the things that you're going to have to confront is putting together a financial forecast. And you really have to start wrestling with that and showing that the whole thing works. When Ken is saying, we want to see that you've got valid assumptions and you've got reasonable answers. Here's some reasonable answers you're going to have to show. That your gross profit percentage is greater than 50%. What does that mean? It means the revenue minus the cost of making your product has to be give you a margin of basically 50% of your revenue. And actually, they would like to see a whole lot more than that at an early stage company because things are going to go south. But you have to show them pretty convincingly that that's going to work. Because if you don't have 50% gross margin, it's highly unlikely you're going to have any kind of earnings at the end of the day. So what comes after the gross profit line is a lot of your overhead expenses, sales expenses, rental of buildings, just general and administrative cost. And that eats up a lot of money in a small company because it may be small dollars, but it's a big percentage of what you're doing. So first thing to look at is, can you put together a convincing case that small scale, you've got a 50% gross profit margin? And how do you get there and what's involved in it? So that's an important step. The second one, and I know one that Thomas likes, is sit down and think through what it will take for you to get $1 million in revenue. How many bodies to assemble whatever you have? How many components? What do they cost? It's on the same journey as to try to nail this stuff down. So think of those two simple little metrics when you're putting a plan together. Let's go to Mark Roost.
Hi. I had a thought about, or I have a thought about what you're talking about the person who wants to do nonprofit. And our approach to it, I like nonprofit stuff too, but we need to make money we need to be able to fund it because I want to do radical nonprofit stuff. So by having a very profitable set of products and then devote and maybe making the company a benefit corporation and or a mission corporation to avoid stockholders being misled and feeling that they're not getting everything they should get when we go ahead and give money into the nonprofit sector. Just to cover our backs. But I figure that we can go in and do. There's a couple main things. We can go in and provide the funding or the financing for communities to buy the technology they need to get into the market economy, along with the energy stuff that we provide. But another thing is running our cash flow through public banks and through credit unions, so that they have the multiples to be able to administer the nonprofit, the small businesses and nonprofits to administer the money that they need to be able to make it. So that's basically passing off the due diligence to an organization that's there to do it and giving them the money to be able to use that skill they have and actually make a difference.
Okay.
Yeah.
Good thoughts and insights there. Thank you, Mark. Thomas?
Sorry, my dog is jumping up and down and
Oh, all right.
and making like monkey noises.
Other questions from
She's trying to get
those?
my attention. So if you see me kind of going like that, it's
All right. Any other questions from the audience there? Cynthia, it looks like you're about to ask a question.
Sure. Hi. I was just curious if the SAC Angels have anybody in the shipping logistics space for e-commerce.
My guess is yes. There are over 85 members now. It's a very diverse group. And there's somebody in there, I'm pretty sure, that would have to deal with it. I don't know who that would be, but the president of SAC Angels is John Peters. You could also approach either of the two gentlemen that we heard from tonight and ask the question. But my guess is, yeah, that's a common enough thing to be doing as a business that somebody's going to have some good insight into it.
Okay. All right.
Even if they're not in the same business, but everybody who manufactures stuff has to use shipping logistics.
Yeah.
So they can tell you how they do it and what they face that's a problem, and that could be even more useful information for you.
Yeah, the basic insight they'll probably give you is let somebody else do the shipping.
Yeah, I'm actually addressing the last mile security.
Yeah. So what I would say is investors love to help people network and move people along, even if it's not usually, something that they can do financially. Typically they being able to try to move someone in the right direction is, in their interest just in general. So asking them and kind of, having a sit down where you talk and say, hey, this is what I'm trying to look for someone who has this knowledge or things about it. Because at the end of the day, they all fantasize about being, as they mentioned, everyone wants to be the last money in because they set the rules. Also, they're the closest to getting their money back. So when they know that they're working with you ahead of time without having put money in, it's something where they're like, hey, you know what? If they do really well here, they demonstrate that and follow what I say, they might be someone that I could work with more in the future. So they see it as an opportunity, not maybe to do something with you right then, but to send you in the right direction. And then maybe, they'll be like, hey, this person is really good. I'm going to follow them.
Okay, thank you.
So Professor Andy Hargadon, who's the head of the Institute of Entrepreneurship and something else, it's the IIE, anyway, over at UC Davis. He's written books and articles about networking. He sees networking as the keys to the success of entrepreneurs because there's always somebody that knows more than you do. And you'd be surprised as to how easy it is to get them talking and to get their help. So, big one in what you're trying to do is just consider anybody you talk to as a potential contributor of knowledge and information. And every angel in the SAC Angels is willing to do that. Even if you don't submit them a proposal, they're accessible and you can sit down and talk to them. So network, network, network. Other questions? Let me raise one. I'm surprised people haven't asked. Crowdfunding. Another way to raise money is to go on the internet and ask for people to put money into your idea. Now, there are all sorts of forms of crowdfunding. Some of it is just straight donations. Help me have a great birthday party for this guy who's 99 years old. And people will contribute. It's amazing how much money this has raised. I can't remember the figure off the top of my head. I just wrote a piece on it. But it's like $15 billion has been raised in crowdfunding. And it's an amazing amount per year. It's like now running at like $6 billion a year. Some of that is raising money to fund companies. So we've been helping a company here, has a clean tech innovation. They just closed, this is at least their second, might be their third crowdfunding round, and raised $782,000. The round before it was $155,000. They didn't do quite as well, but they took the money, they did more development of the product, more research on the customers, came back with something, and put a heck of a presentation together. So between the two sources, they've got over $900,000 to move their company forward. That's probably a rare achievement, but they really set their minds to it and accomplished it. But the bottom line is, if you look at the presentation that they made in webinars to promote their crowdfunding campaign, it's the same stuff we've been talking about. It's a pitch. It's got the same structure. It has the same thing about giving people confidence that you know what you're talking about, etc. So there are other ways to take your idea and amplify it with this pretty big megaphone called crowdfunding. There are still perils. And the number one peril is you got anything that's raised $15 billion and is adding to it at $6 billion a year, you know there's going to be scammers. So you have to be really careful about raising money that way. But it does seem to be something that's viable. And the most important innovation in this sector is the criticism used to be, well, you do crowdfunding, you're going to wind up with 1,000 small investors. And then when you want to go to the next round and raise money from serious equity investors, they're going to say, I'm not going to deal with 1,000 investors and wait for you to get 75% of the people on board, which is very commonly for doing anything to put in more money or to sell a company. So the SEC changed its rules and it said, well, you can create a separate entity and the 1,000 investors go into there, and they, by investing, have agreed to terms which say there will be a lead investor out of that group, a manager, and when more money needs to come in, there will be a vote taken of the 1,000 people, but the company and the new investor will only have to deal with the manager of the crowdfunding fund or the lead investor there, and that makes it much simpler. So things got much more viable when the SEC said that was an okay thing to do. But there are all sorts of things that you're going to be learning about raising early money. There's doing it private markets with accredited investors. That's another good step, a 504c raise. Crowdfunding is usually dealing with unaccredited investors. Usually the minimum amount that somebody puts into that kind of crowdfunding campaign is $100 or $200. So you really are dealing with some pretty small investors. But there are other ways to skin this cat. But I think it all relates back to you got to do your homework. You got to be able to answer their questions and really show that you know what you're talking about. Okay, Mark, you wanted to add a comment?
Thank you. Yeah, I'm fascinated by that. I had looked into crowdfunding a year or 2 years ago and sort of been discouraged. So, but what you just said sounds like what we're thinking about for a convertible note, because we've got a small investor who walked up to me when I was doing the thing at Placer County and said, I want to invest in you. And so because of the 6 rule, the 6 maximum number rule, William said we should put a group together, have her put a group together. So where is the rule? How can I find the in-depth information about that?
So I just wrote an article about it. So it has some links in it to what you need to know. So there's all sorts of data that's been collected. There's all sorts of analysis that's been done, Mark. And then there are law firms now that will lead you through it. But if you're interested in how that happens, part of getting it done well is choosing the right platform that you go to.
Mm-hmm.
Okay, footnote,
Yeah.
It's probably not GoFundMe and it's probably not Kickstarter. They have high fees, and Kickstarter in particular has a rule that if you don't meet your minimum, you have to give all the money back. So that's sort of discouraging. You miss it by $1 and you got to give all the money back to the people that were backing you. So there are other platforms, and the one that we've had companies have positive experience with is called netcapital.com. So it's just netcapital.com. And they will educate you on a lot of this stuff. They seem to be knowledgeable, also ethical, and a fairly reliable source. So I would go to them. I would do some other work on Google. There's a thing called, well, at any rate, read my article, and I've got
Where's your article?
I
Where's
put it
your
in the
article?
chat.
It's on the website, and he put it in the chat.
Also,
great,
there's
thanks.
WeFunder, so you'd want to look at equity crowdfunding, which Kickstarter and Indiegogo are not equity crowdfunding. So,
Well, it can be, but that hasn't been working out too well. Who wanted to raise equity, so they turned into more like donation campaigns. but there's hundreds of platforms to raise money on crowdfunding. That alone scares me. So you have to pick through those fairly carefully and get some references.
Thank you.
Okay, was there anybody else that had a comment or a question on our first session here? All right, so next time, which is next Wednesday, we're going to talk about where's the best source of your first serious money. The difference between grants and contracts, and equity investment, the landscape of what all these things are that are out there, the nature of grants and contract funding, how to search efficiently for what these grant opportunities are. We'll have a guest speaker. His name is Sadal Trabowski, and he has a huge search engine and database, and I guess I'll have to say AI that he uses. He has a query that you fill out, and then query the database to see what it punches out in terms of things that you may qualify for. And his advice is put the query in several different ways, see what you come up with. He offers 1 week free of his Open Grants platform. So he'll lead you through what that can do for you. And hopefully, if you're interested in doing that, take his free 1 week offer. And actually, if you go to his monthly service, it's pretty cheap. But then we're going to have to talk on the 22nd about what it takes to write a successful grant application. And your success is markedly improved if you can engage a professional. So we'll talk about how that can be done. Some of the professionals will work in advance of getting paid. They're confident of their ability to get you a grant, and you'll have to pay them on the back end. But there are ways to get that done. And if you want to do it yourself, there are some things that can be learned about how to do that. And we'll talk about where you get those grant applications going into. A lot of government agencies, but it's also philanthropic foundations. There's also a number of things that are out there, family funds, that will allow you to make applications to them. We're going to talk about the whole landscape of what's out there. And finally, on the 29th, we'll be talking about when you do have to give your 5-minute pitch, your 30-second overview, how you go about doing that. What are the important things you need to know about that? So remember what I said. If you want to apply for the money that Carlson Center and Growth Factory are putting together, $85,000 in equity, $20,000 in non-dilutive money. That's due June 1st. So take a look at that application as soon as you can. All right, Cameron, bookend this for us. You started us out. Any end comments?
No, just appreciate everyone showing up and engaging in the conversation. And thank you, Thomas and Gary, for leading the charge. Thoughtful discussion, and I'm glad Jim and Ken were able to join and share a little bit about their investment. And feel free to check out, I threw a couple links in the chat. If you have any questions related to AngelCon, please don't hesitate to reach out, and look forward to having you apply. Applications close June 1st. And then I also threw in the chat the sign up for session 2. So we'll be back next week on Wednesday, and look forward to seeing you then. So thank you all.
6 to 8 p.m. Thomas, any final words?
Nope. Look forward to seeing you guys then next week. First money, where is the best source? As Gary said, with Sadal Taberski of Open Grants.
All right. Thank you very much. We'll see you next Wednesday.
Bye. Thank you.